Welcome to today's iView Market Pulse, where we provide a comprehensive analysis of recent global financial market developments. If you find our insights valuable, please like, subscribe, and share our channel. Today's two key focuses. 1. Acute inflationary pressures. Last week, the University of Michigan published its Consumer Sentiment Index alongside several inflation-linked metrics. These data points suggest that U.S. inflationary pressures remain persistent and entrenched. The enduring effects of previous trade policies implemented under the Trump administration continue to exacerbate the inflationary outlook. We will delve into the nuances of these factors momentarily. 2. A pivotal week for central bank policy decisions. In addition to the upcoming Federal Open Market Committee (FOMC) meeting, several central banks are convening policy discussions this week. These gatherings have the potential to drive significant volatility across major currency pairs and financial instruments. Stay tuned as we outline the key implications of these policy meetings. If you have questions related to fixed income securities, foreign exchange markets, or other economic indicators, please don't hesitate to leave a comment. First, a decline in the University of Michigan Consumer Sentiment Index. The latest Consumer Sentiment Index continues to show a downtrend, registering at a low of 57.9. This represents a historically weak reading. The last time sentiment was this suppressed was in 2022. Initially, post-election optimism regarding Trump's presidency buoyed sentiment. However, subsequent tariff announcements and protectionist policies have steadily undermined consumer confidence. The implementation of these tariffs has fueled economic uncertainty, directly impacting household spending behavior. This erosion in sentiment now feeds into core consumer spending indicators, such as retail sales data. Later tonight, the release of U.S. retail sales figures will serve as a crucial barometer for gauging the potential turnaround or further deterioration of market sentiment. Market participants broadly anticipate softer retail performance, but confirmation will hinge on the official data release. Second, inflation expectations at historical highs. One major driver of heightened inflationary expectations is the tariff regime, which has induced upstream price pressures. Short-term inflation expectations have surged to 4.9%, a peak not seen since the inflationary spike of late 2022. Similarly, long-term inflation expectations have climbed to 3.9%, marking a 30-year high. These elevated expectations are particularly concerning, given that even prior periods of significant inflationary episodes did not see such levels. However, it is worth noting that inflationary expectations do not always translate directly into actual inflation. For example, while the trade disputes of 2018 increased tariff rates, they did not trigger a protracted inflationary spiral. Nonetheless, the market's sensitivity to inflationary signals means that further declines in consumer sentiment, coupled with underwhelming retail data, could deepen concerns over a potential economic slowdown. Additionally, deteriorating labor market expectations, evidenced by the 50% of University of Michigan respondents forecasting rising unemployment, add another layer of macroeconomic risk. Key inflation indicators and Federal Reserve policy responses. Despite last week's Producer Price Index (PPI) data coming in weaker than anticipated, U.S. Treasury yields continued to rise, a counterintuitive market reaction. The driving force behind this paradox was an uptick in prices within PPI service categories, particularly healthcare and financial services. These components are poised to exert upward pressure on the Personal Consumption Expenditures (PCE) price index, a critical metric closely monitored by Federal Reserve policymakers. Bloomberg forecasts indicate a PCE monthly gain approaching 0.35%, with the potential to reach as high as 0.4%. Such figures would reinforce the narrative of stubbornly persistent inflation. As a result, Bloomberg has revised its year-end PCE inflation forecast upward from 2.7% to 2.8%, signaling entrenched core inflation throughout 2024. If the U.S. escalates its trade conflict, further elevating tariff structures, inflationary pressures could intensify, darkening the overall economic outlook. Market-adjusted Federal Reserve rate expectations. Expectations for Federal Reserve rate cuts are diminishing. Initially, markets anticipated 3 rate reductions by year-end. These projections have since been pared back to 2.5 rate cuts. As we approach the December meeting, the consensus remains fluid, fluctuating between 2 and 3 rate cuts. Consequently, U.S. Treasury yields have stabilized, with signs of a modest rebound. Major economic events to watch this week. Tonight's U.S. retail sales data release is expected to be pivotal. Strong expectations have been set, but actual performance will be critical. On Thursday, the FOMC meeting will take center stage. While rates are anticipated to remain unchanged, investors will closely scrutinize the dot plot projections and the Fed's revised economic outlook. With multiple central bank meetings scheduled globally, the so-called Super Central Bank Week could introduce significant market turbulence. U.S. government avoids a funding crisis. Last Friday, the U.S. Senate passed a stopgap funding measure to ensure government operations continue until September 30th. Although the Democratic Party expressed dissatisfaction with certain budget cuts, they ultimately agreed to the deal, thereby averting a shutdown scenario that would have had severe repercussions. Geopolitical developments under Trump's administration. This week, Trump is slated to meet with Russian President Vladimir Putin, a meeting that could yield progress in the ongoing Russia-Ukraine conflict. Meanwhile, U.S. airstrikes targeting Houthi forces have escalated tensions in the Middle East. These developments heighten concerns over potential disruptions in shipping routes, particularly through the Red Sea, impacting energy and trade flows, global market reactions, and sectoral performance. U.S. equity markets posted a robust recovery last Friday, driven by a technical rebound. This week, NVIDIA's GTC conference is expected to serve as a major catalyst for the tech sector. Major players such as Tesla, NVIDIA, and leading semiconductor firms continue to experience strong upward momentum. However, Taiwan Semiconductor Manufacturing Company, TSMC, faces ongoing pressure, influenced by expanded U.S. investments and potential collaborations with Intel. Foreign exchange and commodities overview. In foreign exchange markets, the US dollar index remains subdued amid strengthening European currencies. Germany's fiscal stimulus measures have propelled the euro higher. The Japanese yen has shown signs of stabilization, although wage negotiations have fallen short of expectations. Both the Bank of England and the Bank of Japan are likely to keep monetary policy unchanged. Commodities and cryptocurrencies. Crude oil prices remain weak, with recent geopolitical events having limited impact on supply levels. Gold prices continue to firm, supported by uncertainty surrounding Trump's policy agenda. Bitcoin is rebounding as risk appetite returns, signaling renewed investor interest in digital assets. Concluding remarks. That wraps up today's iView Market Pulse. As we monitor the week's key economic releases and central bank actions, keep an eye on evolving market conditions. If you have any questions or comments, please share them below. Thank you for joining us today.